Well, it's good to have you with us this morning. We are seeing a bit of weakness for stocks with the TSX down about 15 points. More selling pressure for the S&P 500. I guess notable is the fact that it has dipped below 5,000. We'll see what happens over the course of the trading day. That U.S. benchmark had closed above 5,000 in 4 of the 5 sessions since clearing that milestone for the first time not long ago. As a lot of strategists come back from a long weekend, we've got a couple of interesting calls. We've got Goldman Sachs raising their year-end target to around 5,200, so they see maybe 3 to 4% upside for the U.S. benchmark. UBS sees maybe 5,400 in the cards, so they're suggesting maybe 7 to 8% upside. Our next guest, go by comparison, is a little more cautious. Scott Wren is a senior global equity strategist at Wells Fargo Investment Institute, one of our regular guests. Scott, it's great to see you here. So always the positioning on Wall Street. We see, you get paid to make a call on where we go from here. But what's your general sense on why maybe being a bit cautious right now is the prudent thing to do?
Well, I tell you, John, and good morning. For us, earnings estimates, we think they're too high. The consensus is too high, which is maybe 244, 246, somewhere in there. And then, you've heard some numbers that are maybe 250 or a touch higher. We're at 230. So we think that earnings estimates are way too high. We think the economy is going to slow noticeably, and our peers on Wall Street aren't taking that into account. We've been in the 3-cut camp from the Federal Reserve, and certainly if you look at where core CPI came in, you could make an argument that, March and May are off the table. So I think there's a few headwinds out there. Consumer spending, we're expecting that to slow as the labor market weakens. So I think there's a few things going on that make us cautious. We just think stocks, particularly, if you look at tech, if you look at communication services, those two sectors, they're pretty stretched. So valuations aren't making us very enthusiastic either.
So if I look sort of at all the sector performance for the S&P this year, where you're right, tech's had a huge run again this year, and everyone's going to watch what happens with NVIDIA this week. But because of the reassessment on how quickly we see interest rates come down, and this gets a little confusing because we just had an inflation report in Canada that suggested maybe we'll see interest rate cuts sooner versus later. But in the U.S. for now, there's a belief that maybe it's later. You saw some of the utilities and real estate stocks struggling because there was a reassessment on interest rates. And you did see some investors leaning into safer stuff like consumer staples. So consumer staples in Canada have done well. We were talking about Loblaw before the break. And consumer staples in the U.S. have done relatively well. If you're a little bit more cautious on the market, sector-wise, how are you positioning right now?
Well, really, if you look at just outright defensive sectors, we like healthcare. Now, utilities and staples, those are obviously very defensive, but, it depends on what you think the magnitude of the slowdown is going to be. If you think we're going to get a second and third quarter GDP number that could be, 1% or maybe a touch below, something like that, I'm not sure that warrants a wholesale change to a real defensive sort of a state as far as portfolios go. So for us, the economy is going to slow. The chance of a recession, while it's not zero, is a lot lower than, let's say, what we thought it was a year ago or something like that. So we wouldn't go full board defensive. Utilities and staples don't look like a place that we want to be. We want to stick large cap. We want to stick with U.S. over international. We're certainly not buying the Russell 2000 in here, even though the performance differential has been big. It's going to underperform if we get a pullback in the S&P 500, which we think we will. So that's really where we stand. We don't want to get overly defensive and just completely hide. There's some things under the hood you can do, which we've been doing. But other than that, we just think stocks are pretty highly valued right here.
Okay, and I'm looking for our television audience at the sector breakdown of what you like. You referenced healthcare, but industrials, materials on there, as well as energy. We were talking about energy earlier, the price of crude, that is, which is kind of on the doorstep of $80 US right now. I would say we've been pretty much in a $10, call it, range for the last few months. And, we've heard just about every headline and watched the reaction, I would say we've sort of had muted reaction to all of it, muted reaction to geopolitical risk, muted reaction to the data points that are supportive of demand being there, data points that are supportive of too much supply being there. So what is your assessment of what's going on in the energy market right now?
Well, I'll tell you, John, what we did was we thought financials ran up too far, too fast. We took money out of financials. We downgraded financials. We thought that oil is not going to trade much below 70 if it gets below 70 at all. And, energy was down on low oil prices. So for us, we think there's a little bit of upside between now and the end of the year in oil. I think probably over the next few months as, clearly Europe's, if they're not technically in a recession, which they probably are, they're going to be in one soon. Emerging markets, China, not all that great economically. So I think it makes some sense that oil would have a tough time moving higher under those conditions. And as I mentioned, the U.S. slowing too. But still, if you look out and more longer term, there's still tight supplies out there. And so it makes sense to us that oil's up here. I can understand the lack of patience with some investors who would like to see oil prices higher. But I think you have to take into account what's going to likely happen in the global economy here over the next 3-4 months, and that's a slowing. So you have to ride it through that. We think we're in a commodity bull super cycle that started back in March of 2020. This is just a pause, which typically happens during commodity bull super cycle. So we're positive on oil longer term, but I think we might spend a little time in this range that we've been trading in over the next 3, 4, 5 months.